Ever wondered how your debt-to-income ratio affects your home buying process? Well, today we're diving right into that. I'm Irma Morales, your trusted realtor, and I'm here to shed light on this key concept. The debt-to-income ratio, or DTI, is a crucial factor that lenders consider when you're securing a mortgage for your dream home. Misunderstanding this can lead to some unexpected hurdles. Stick around to find out how to calculate your debt-to-income ratio and how it can make or break your home buying journey. The debt-to-income ratio, referred to as DTI, is a key factor lenders consider during the mortgage application process. But what exactly is DTI? Simply put, it's a way to measure your financial health. It's calculated by dividing your total monthly debt payments by your gross monthly income. This ratio gives lenders an idea of how well you handle your debts and how likely you are to repay the mortgage loan. Let's break this down with an example. Suppose your gross monthly income is $5,000. Out of this, you pay $2,000 towards debts, which could include student loans, car loans, credit card debts, and the like. Your DTI then is 40%, calculated as $2,000 divided by 5,000 times 100. Why is this important? Well, lenders typically prefer a DTI of 36% or less, with no more than 28% going towards housing costs. This is because a lower DTI indicates less risk for the lender, as you have a good balance between income and debt. However, different lenders have different DTI requirements, and some might be flexible depending on other factors like your credit score, so don't be discouraged if your DTI is slightly higher. With this understanding of DTI, you're one step closer to being well-equipped for the home buying process. Now that we've got the basics down, let's delve into the specifics. When calculating your debt-to-income ratio, housing expenses take the front seat. So, what exactly comprises these housing expenses? Let's break it down. Firstly, there's the principal. This is the actual amount of money you borrowed to buy your home. Then, we have the interest, which is essentially the cost of borrowing that money, set by your lender. Next up, we have taxes. These are property taxes imposed by your local government, used for public services like schools and roads. They vary widely based on location, so it's vital to factor them into your budget. Lastly, there's insurance. This includes both homeowner's insurance, which protects against damages to your home, and, if you put less than 20% down, private mortgage insurance. These four elements, principal, interest, taxes, and insurance, commonly known as PITI, form the backbone of your housing expenses. Understanding these components helps you anticipate your monthly housing costs and how they affect your DTI. Did you know that your car payment can significantly impact your DTI ratio? It's a fact. When lenders assess your ability to manage payments, they take into account all of your monthly obligations, including car payments. So, if you're making hefty payments for that shiny new ride, it can push up your DTI ratio, potentially making your dream home seem a little further out of reach. But don't worry, there are strategies to manage this impact. For instance, consider paying off your car loan before applying for a mortgage. This could lower your DTI ratio, making you a more attractive prospect to lenders. Alternatively, if you're planning on buying a new car, it may be worthwhile to delay that purchase until after your mortgage is approved. Remember, every little bit helps when it comes to improving your financial picture. So, managing your car payments wisely can help you keep your DTI ratio in check. Your chances of securing a mortgage are higher when you minimize expenses on credit. Now let's dive into some practical tips to reduce non-essential debts and improve your debt-to-income ratio. First, consider paying down high-interest debts such as credit cards or personal loans. These not only weigh heavy on your DTI ratio, but they also cost you more in the long run due to high interest rates. Next, avoid taking on new large debts. That brand new car might be tempting, but remember, it could potentially hinder your chances of securing a mortgage. Third, create a budget and stick to it. By being disciplined with your spending, you can gradually decrease your overall debt and consequently, your DTI ratio. Lastly, consider increasing your income. Whether it's a side hustle or a promotion at work, a higher income can significantly lower your DTI ratio, making you more appealing to lenders. Remember, the lower your DTI ratio, the more appealing you are to lenders. There you have it. A complete guide on understanding your debt-to-income ratio in the home buying process. We've covered the basics of DTI, dissected what constitutes housing expenses, examined the impact of car payments, and shared methods to maximize your loan approval chances. Mastering these concepts is essential in the quest for your dream home. With this knowledge, you're better equipped to navigate the home buying journey. Don't forget to subscribe for more home buying tips and tricks. Ever wondered